Welcome to the Push Ventures podcast, Push Your Advantage, and we appreciate you tuning in to this installment of our Push Your Partner series of interviews. In this series, we are discussing various topics with different contributors to the African tech ecosystem. And today our guest is Fabrice Boulle. Fabrice is Mauritian and he studied finance and economics in Paris. Since then, he spent the better part of his career working in private equity and venture capital in Africa. He has led the construction of 3 startup portfolios and is currently raising his next fund, convinced that tech startups have a critical role to play in a sustainable socio-economic development of the continent. Presently, he lives in Mauritius with his wife and 2 kids, and he loves windsurfing as well as the local food scene. Together, we'll be speaking about the local and foreign investor debate. We'll be touching upon points such as their firepower structures and the network and its benefits that they bring with them, their know-how and effects of both of them onto the ecosystem as a whole. And Fabrice, are you ready to be pushed?
Yes, definitely. And thanks for having me on your podcast, man. It's a pleasure to be here.
Thanks for being here. So Fabrice, when we speak about the firepower in structures, from your perspective, when you look at the fund structures that are there in the ecosystem versus a lot of family offices which are also playing, which structure do you feel is most suited for startups in Africa, and why do you think that is the case?
Well, yes, those 2 types of investors, and even if we add the angel investors, are very different partners for the startups. Obviously, I can vouch for the benefit of having a venture capital fund as your investor, because we are structured, we are active, and we have a lot of benchmarks to advise you, to support you, and to introduce you to many of your potential mentors, clients, and also next large VC fund to fund your next growth phase. It depends. Family offices tend to be more passive investors, yet they have a good network, but they are not like professional investors. And to that extent, you might lose on some, support and value addition from them.
Do you feel that those networks, however, are sometimes kind of a good trade-off for family offices? Because whilst they're not as active, they might bring those networks which really help kind of to catapult startups to the next level at times?
Yes, indeed. To that extent, if you are able to get an investment from a family office which is connected in your sector, who has a deep network in your in your city or in your country, that is obviously a very good first time investor to get an investment from. It is really with them which you'll be able to get that local credibility, and they will vouch for you with the network of corporates and probably the network of family offices as well. So it is indeed also a very interesting aspect and very interesting partner at the earlier stage of your funding and equity story.
Do you see family office also contributing a lot on a later stage?
They can contribute, but you have to ensure when you want to partner with them that they have the right network for that, and if they have deep pockets to be able to fund you. It is true that some family offices that I came across do have a good exposure to the VC scene locally, but also internationally. So that can help you to have access to those funds elsewhere and to the more global VC coming in Africa. So I think it's always a matter of choice for the startups. As for every partnership, you have to kind of due diligence your partners as well. And when you're satisfied that they will bring you the value over and above the only early stage funding, that they can accompany you for the long run until a Series B, a Series C, and it will be even greater because you'll get both this local knowledge this local network, the local credibility, and also then the ability to grow with them and to get them to accompany you alongside or during the journey.
You touched upon a really good point here now with partners, and thinking back about the time that we first met, like 5 years ago when you were with Compass, where you with Compass had considerably more firepower than us at Push. Yet we always tended to collaborate quite a lot, actually. And from your perspective at the time, what did you feel were the reasons or the value of working with us?
Yes, what I love with Push and you guys as a team is that you had a much more deeper local insights on the cultural fit of the different solutions we were looking at. Also on the founders themselves and where they would come from and what was the background, and you have the ability to confirm that these guys launching that solutions was a right fit for the local markets. You also had the ability to test during the due diligence with some of your corporate friends and friends and family that this new solution was suited for the market, or what that these corporates would be keen to adopt, to test, to pilot those new services and product. So this local knowledge is key for a foreign investor. We tend to know our markets and to know different markets, and sometimes we are quick to make some benchmarks and assumptions, and we think that if it's been working in a neighboring country, it might be working in Kenya, for example. But obviously, that's a very dangerous shortcut, and you sometimes you don't even know that you're taking it. So, sitting down with Push, sitting down with you, and walking across the streets or in the streets with you made us understand that this startup was not probably the right startups. In the meantime, you would bring to us very interesting early stage startups which would have met earlier than we would do, because you are 100% on the ground, and you would have met with them much earlier, and you would have been able to do these first meetings where you can vouch for the team, and you would have assessed their quality and just their mindsets. And these are very great ways for foreign investors to actually invest into a country and to make sure that we do the right choice at early stages.
You mentioned a lot of very interesting parts. One of the things I definitely picked up here was also the kind of approach to Africa that a lot of people have when they look at the whole continent, rather than looking at the very many different countries that we have here, and that having local knowledge for the respective markets is crucial. And one question that just popped to my mind here, particularly with your background of being, obviously fluent in French for particular reasons, right? But when you look at Francophone Africa compared to, for example, the English-speaking part of the continent, is there something that really, apart from the language, draws you to really separate the two of them from how the funding works? Is there more, for example, funding coming from the US towards English-speaking and more from like French country, France as a country,
Yes,
for example,
indeed.
to the French? Okay.
Yes, there are multiple differences across those regions. The Anglophone Africa and the Francophone Africa, and culturally, the way that the business is done, and even from a legal perspective and the constitution of different countries. One is common law, one is the civil code in France. So these things tend to make a huge difference when you try to start a business into those countries, and then even more so when you try to fund a business into those countries. So It is for sure. It makes for sure a difference in terms of the volumes, in terms of investments and number of deals which have been done into the Anglophone Africa and the Francophone Africa. For some reason, and definitely led, for example, by M-Pesa and a few startups who have emerged about 20 years ago in Kenya, the ecosystems are much more developed, and there is this strong tie and strong relationship with the US, which have made and which have led more foreign investments into Kenya and also into Nigeria. The Francophone Africa, however, is now starting to flourish, and we can see that there are large rounds being raised from some fintechs, and that is very positive. Also now the corporates as well are starting to work more with startups in the Francophone Africa, and the regulators are starting to open their eyes and try to be more conducive, because the digital solutions and the startups are really beneficial to the economy and to the growth of a purchasing power, and to many positive aspects to the development of these countries. So yes, there are a lot of differences.
One of the things I just like to throw in for your information, I'm not sure if you read about it, but even Safaricom now has received the clearance that they can invest in the startup ecosystem as well here locally in Kenya. Don't know whether you saw the news.
Yes, I did saw the news. It's a very good thing. Yes, it is. I would advise them to take on, as we did actually in the past, but an external team, professional VC investors can really take like that independent view about which startups are developing the most impressive and scalable and even exportable solution. And even if sometimes it affects a little bit even Safaricom, but it's a very good thing that the largest corporates in Africa are starting to launch their own corporate VCs. It is it's good for the different ecosystems. So that's a good news.
Now, when you look at the ecosystems and the different funding stages, maybe with respect to the corporates who are now moving in, do you feel that there are certain funding stages in particular that lack sufficient funding, where if you were Safaricom now, you would say, this is actually the stage at which I would come in because it makes most sense for me as a corporate as well? And on top of that, because there is a lack of sufficient funding in the market?
Yes, obviously the early stages are the one who are lacking funding. The very good teams often lack the ability to finance their ideas and to get those first checks. So it is definitely a stage of development where, as VCs, we can find a very a very conducive environment to make good investments, to partner with those teams. Obviously, it is very risky, and it is there is many more unknowns about the traction and even the scalability and the quality of a team. So yes, I would advise. Yes, Safaricom could have a instrumental role playing into that stage, but it really depends on their strategy. But I think it is also the role of the angels and the role of the local family offices or of a corporate as well, to join forces and to spark their ecosystem and to more than only finance those teams and at proof of concept stage or MVP stage, but also to partner with them to adopt their solution, to be ambassadors for their solution can be even more important for the startups.
It was a very good point about what local investors should also be looking at in order to grow the ecosystem over time. Now, when you're thinking about local investors and foreign investors, and from your perspective, what would you say is kind of a differentiating factor in terms of investment strategy, risk appetite, the timelines, the size, the industry and focus that they have, and exit strategies? I know we've touched upon some of the aspects already during the course of this interview, so you may just want to point out some other elements that spring to your head.
Well, from what I've observed, obviously the local investors can, assess and validate those cultural nuances and invest and take the first risks, and also empower the startups to penetrate the market. So that's a very good thing. So they could come at the pre-seed stage and seed stage, and even like follow on at Series A stage. For most other funds, some local funds have deeper pockets and can start at seed and even Series A and go towards the Series C and Ds. From an exit point of view, the local investors can expect to exit as from Series C and Series D, where those large global VCs come and do rounds around the 50 and the hundreds, and might want to clean some of the earlier, might want to clean the cap table and get and give some liquidity to the earlier investors, to the angels, and to the family offices. And that is a very, I would say, natural evolution of the funding of a startup, where some VCs replace other VCs, and some are experts into the first stages of development, and some others have more expertise and more willingness to help in the later stages, even towards a trade sale or an IPO, which we would be very happy to see happen more often in Africa.
Okay, maybe one last question towards firepower. Let's assume one of the listeners is a startup founder and wants to tap into your firepower. Now, as a foreign investor, what are the 3 things that you look for ideally that essentially make you pull the trigger and invest?
Yes, this must have been heard thousands of times, especially those entrepreneurs that have listened to a few podcasts or read a few articles. Now, obviously, the most important aspect for us is the quality of a team. And we look at the founders' market fit, where we really want a team of founders who have complementary skills, expertise, and experience. So the founder market fit is really the number one aspect that we look at. Definitely what we want, obviously, is that there is a strong relevance in the local market, that there is a high penetration, and that we can see that these startups will become, one of the local leaders in its own market, to be able to develop, to find a product market fit then in their local market. Obviously, then from a foreign investor perspective, would then look at the scalability, inside Africa itself, or even more interestingly, outside of Africa. And these would be, the first top priorities or top parameters that we would be looking at when assessing an investment.
It's very good to hear, because it shows me that not everything is different with foreign and local investors. Probably that's why we worked so well together.
Yes, I would believe the fundamentals are very similar. It's, I would say, investing into startups requires a lot of, systematic approach with regard to your parameters and with regard to the fundamentals. And at the end of the day, what you're really looking to build is that trust with the founding team, that reinforce your intuition and your belief that, notwithstanding all the obstacles and challenges that this team will face, that they will be able to overcome those challenges and even more so interestingly, also to collaborate with you, to listen to you, to accept sometimes your criticisms and your tough questions, in order for them just to assess the potential action plan, and make sure that they have your backup. This is very important for the next round of financing, or during, for example, this funding winter time. That collaboration can unlock more easily some bridge financing, because you as an investor really trust that company. You know how they take decision, you know how often they reassess their point of view, and that they're not stubborn, and that they like to take advice from everybody in a certain way. So yes, we're working in a very similar way.
That brings me to one last tough question on this point, because you just pointed out regarding the team and they have to overcome their challenges. How would you approach a situation where maybe there's a startup founding team, which maybe 3 or 4 people, and then 1 or 2 break away because they can't overcome the challenges together? How do you look at that from an investor's point of view?
Yes, that is. I have one case like this, and other different kind of founding team problems. Yes, I tend to see these big challenges as an opportunity to reassess the different aspects of the development of a company. It is definitely a setback. It is definitely a problem. It definitely affects the growth, but it also opens up for a pivot in the strategy, for example, of a recruitment of people with different skill sets. And so it's not an end. It's actually the beginning of something new. So, and once again, as I said, I think if you trust the CEO or the founder, or the founder who is staying into the company, and I hope it's the case, and it's the case in my situation, you also try to support him with empathy and an acknowledgement of the fact that this is not uncommon into the life of a startup. Yes, there are some feelings, and you can be mad sometimes, but you let these feelings go away. You just sit down and you take the time to discuss, or and through the days, through the weeks, come up with a solution. So yes, it's not always how do you say that in English? But it's not always a calm journey, obviously.
Absolutely. And once again, we agree. So with that being said, next point would be network and benefits of local and foreign investors. So from your perspective, how beneficial do you feel the networks of some of the international funds are? And have you also seen a lot of the startups that benefiting from them? And maybe you can give us an example of how that really helped maybe kickstart a startup's growth or something.
Yes, definitely. No, yes, the network of the international funds are very important and very interesting. First, and with regard to the team itself, at some point during your growth stage, you might have come up with a brilliant solution for the local market, and have made a big breakthrough, and now you need to start to unlock growth in multiple countries, and even potentially in Western countries. So this type of strategic planning and strategic action is not something which is natural. What I want to say is that these growth plans have been made and have been actioned in the past by experts and professionals who've done it. And we see that it's very scarce to find this type of talent in Africa. And it's you need to be able to recruit those people, sometimes outside of Africa. Potentially, yes, Africans as well. And that would be even more interesting and even more global talents. So that also could come from advisors. And I'm putting some emphasis on this. So being able to recruit and have access to these team members and advisors who've done it before can reinforce your ability to plan more accurately your next growth phase. Obviously, this growth phase will require some firepower, and you might need to raise, a significant amount of funding, and that comes with, with the firepower of global VCs. And when it's VCs tend to co-invest along and they like to get an intro, a warm referral from one of their friends. So it's very interesting for them to get that intro from one of the funds they've been working with in the past and with whom they've had a success, for example. So we've done it for one of our investments at the moment. It's Omniscient. It's an AI data privacy platform which offers data trades on profiling creditworthiness and marketing profiles of people. And we've received investments from globally connected investors who've been able to introduce us in the UK, in Australia, and in the US. So at the moment, we have been able to make these first calls, to have these first intros. And now we can, try to see how our local South African solution can be adapted and adopted in those larger markets and very interesting markets, actually. So this is definitely something that we see as very beneficial.
Thanks a lot for elaborating those benefits of the foreign investors. On this podcast series, I've also made the case that also local investors have a lot of those benefits, which are slightly different though, and in particular with respect to Africa being a very network-driven society still, or the different countries within Africa, not to put every aspect of Africa on one page. Now, if you were a founder, or if you would give advice to one young founder who's really very early in his startup journey, what would you say are the benefits that you feel some of the local funds provide? And if you were to put a price tag on those for one of the founders, how would you kind of advise the founder to deal with that? Because one of the other points I touched upon in the podcast is also the valuation, and that a lot of those benefits you get from some of these, oftentimes also very early local investors, they're sometimes actually worth real money to you in a way. What do you think?
Now, I would say that, yes, I would value a lot, that a young founder, I would say, like a founder who is very early in his journey, can be an old entrepreneur, but still very early in his startup journey. It gives a lot of credibility to the later stage investors that they've received money from I would say sophisticated investor at least. So it is important to that aspect. But yes, I would say that it's key and it's very important to get that first check from a local investor. Once again, it brings the deep insights into the market trend, and it grants access to local network, and it provides mentorship. So it demonstrates for later stage investors that you, as an entrepreneur, are willing to, as entrepreneurs, are willing to collaborate, to open up your equity, to not be the only one on your cap table. So to share that wealth, that future wealth, definitely, and also to accept, the constraints of governance, the constraints of discussing a strategy or arguing a strategy, but also that you embrace the value addition that more people around the table can actually, build a better company, bring their expertise, experience, and bring more people around the table to make that company more solid, more resilient. And depending on your experience as well as an entrepreneur, you might have not seen it all, while people who have invested in many companies have seen some path, some pitfalls, and some mistakes being done. So at least they tend to share that with you. And if you can avoid some of these common pitfalls, you don't fail for the wrong reasons. And all these aspects, all the goodwill that those investors are bringing you, is very important in the future. So while I would say that it's not a problem to discuss the valuation at the first round. You should be open to get some dilution. You should be worried about not overvaluing your company. It is actually a key to get higher valuation at later stages and at Series A and Series B, because you would have created a very strong, locally made and a local leader who will attract a lot of money at very high valuation. And this is how and when you will actually you will start to see that this has been very beneficial to you. And so for all these reasons, partnering with local investors, local angels and family offices or micro VCs are key.
This brings me to my next point, which you also sparked another idea in my mind now. If you're one of those founders, and depending on which stage you're in right now, what would you advise them to look for in the investors they seek? And on top of that, as you mentioned, the local experience is very important and critical as well in order to help you grow your company to becoming a local leader. What is your thought process on a lot of the times that what we see boards where there's actually no local experience on the board of the company?
Great. No, and two different things. Obviously, the team, which is investing in you, and the board that you are composing are two different kind of animals you have to bear with. But my answer to those two aspects come back to the complementarity. Same thing as your founding team. You want investors who can bring you something that you don't have, and you want your board of directors to bring you something that you don't have. And so I always tend to ensure there is a very diverse skill set represented across those two elements, like who is on your cap table and who is on your board. And in the early stages, once again, because you need to be that market leader, you need to prove your ability to find product market fit in your own market. The local investor or the local board member is key, and even more so, more interestingly, if that person is able to understand your market, to understand who are your clients, what are they willing to maybe get feedback directly from those clients once you have started to serve them, is something which will give you some feedback and will help you to iterate more quickly in your local market. So yes, I as an investor, for example, I'm very much into the strategy and the overall development aspect of a startup. But I don't come with an AI expertise. I don't come with renewable energy expertise. So each time we are on a board, or each time I'm discussing with my entrepreneur, and I get a question that I can't answer, I don't try to answer. I just connect them with the right persons. So it's also important to know, who are your investors and what are that network, and because that will help you in the end get access to those type of resources, which will be beneficial. I tend to. I've seen a lot of founders being experts in their fields and knowing most of the problematics, and being able to grasp them. But I've seen how beneficial it is when you put those CEOs in front of a board member or an advisor who've seen it in a different country or in a different continent, and it can just help them not being totally alone when taking that decision. So this is something which is key to me. That diverse skill set around the table is something you should be looking for.
Wonderful. Now, one thing you mentioned before as well that you touched upon was essentially saying local investors kind of add some sense of validation. I had referred to that once as kind of a stamp of approval. Now, as a foreign investor, how important do you think that stamp of approval is, and how important is it for you as a foreign investor to have a local investor partner that you can really trust to help you navigate that local landscape that you, for example, pointed out as well, that value that Push brought to your decision-making process, right? How important is it from your perspective, for investors to have that in the respective markets they operate in?
Well, it's key, actually. No, it's fundamental. You would be discussing with the existing investors on the cap table about the scalability of that business, for example. And I would remember, the Coco Network deal which you've done. When I was discussing that with you, and I looked at that from a throwing perspective, I would have never guessed how deep the market could be. Well, I don't know the latest updates about Coco, but what I've seen and
Crossed 1
growth.
million.
Yes.
1 million
I should have
customers.
trusted you by that time. But yes, definitely, it's, more than just giving us a stamp of, I don't know how to say that, but you just said, but that recognition that it is as a project that has made a breakthrough. Okay, yes, I could see that, but I would have not been able to really understand the depth of the market. So and yes, I think I made some mistakes in the past, not always having the same intuition as you have had, but yes, no. So it is definitely something which I see as very interesting. I see as very important, and that I value a lot. And I would usually not invest into a startup which has not received a local investor money. I think that it is, for me, not a very good sign. I don't say that I don't say that it's not possible for a startup to become a very large and fantastic success without the local investors. But I would say that is, one of these warning signs which we usually look at, and which we usually tend to take as a risk. In the meantime, we've made, for example, we've uncovered some fantastic projects And we've waited for the local investors to vet them for us. So we've been sometimes waiting for 6 months with this local startup, and going and see the different local investors and say, are the corporates going to adopt that solution? Do you think it is too early for the market? Does that innovation answer the real need? And how big is this need? And we wanted to wait for these local investors to invest into that company. So yes, I think it's key for you for an investor, an entrepreneur to get a local investor once again.
Okay, much appreciated this answer is. I think from that perspective, now we can move actually to the next point of know-how. And on the note of Coco, just on a side note, don't worry about it. I mean, we all make mistakes. I've made plenty myself as well, and we learn from them.
Yes, definitely.
So talking about the know-how, now that we've kind of praised local investors a little, let's just really think about the input that foreign investors can give in terms of know-how. And you already touched upon that a little bit by saying that a lot of the foreign investors obviously have access to very different talent pools. Hence, their skill sets are a lot of times very valuable. So what do you really see is the best input foreign investors can provide in terms of know-how?
Yes, I would say the scalability, how to go from one country to multiple countries, how to recruit, the greatest teams, how to export your solution, how to track the right growth metrics, and how to compose a board, which can help you, action that strategy. They bring also that broad network of international clients should you want to export in the Western world. Yes, and they bring with them a more systematic approach towards the monitoring of your performance and the measurement of your performance, which is something which tends to take more and more importance at the later stage of a company. In the earlier days, as early investors and local investors, we tend to focus on the product market fit, and this is where we want to bring the company. And in the later stage, yes, we're more talking about a more structured approach to growth. And the global investors, the foreign investors, would have done it and would have been able to witness actually across the board in multiple countries and continents how things have been done. So once again, it comes to this, what are the pitfalls? What are the best practices? And yes, this is something very valuable. One comment that I would make is that you should start gathering data and measuring your performance from day one. You should be able to understand the importance of a great CFO from the early days, because once you will reach those growth stage development, you'd rather take data-led decisions rather than just intuition-led decision. And you need a strong team around you who can give you those insights, but just not written feedback, but data feedback about how to plan, how to make those decisions. So yes, and I think that, and I've seen that foreign investors, with a lot of firepower, bring that on the table, and it's very key.
Okay, and in terms of local investors, what would you say is the biggest value add that they can bring? We've touched upon many points, so which one would you pick?
Yes, I'm just trying to see which one I would value the most. But I think the network, the client network, because it's key in the early days to test to test your solution and to do those iterations. And it is very important to be able to distribute your product, and to get the market access, the market reach. So yes, I would say that the local investors are, yes, most important and most valuable aspect is that.
Okay. Now, when you look at how both of them evaluate startups, and maybe we can touch a bit on that point of Coco in that particular question. When you're looking at how startups are evaluated by both local versus foreign investors, and maybe when you're thinking about Coco a little bit, do you think there's a difference in how they look at startups at times? Or do you feel, apart from obviously the differences, there's a lot of things which are in common, because you obviously mentioned earlier as well that the foundation of how to look at a startup and how to value a startup and how to evaluate a team and so on is pretty similar?
Yes, I mean, it comes back to the knowledge of a market and the appreciation of the market need and the pain which the potential clients are experiencing. So while the foreign investors, will weigh the global applicability and expected ROI on a much larger scale, the local investors would focus on the local market fit and the immediate impact of that solution. So maybe they have a bias sometimes towards, something which is too local. So they need to understand and we need to appreciate the ability of that team to actually, internationalize their solution. And they should look at the TAM just to be sure that they are not biased. And in the meantime, sometimes the foreign investors, I would say, would have, yes, they should ensure that this company has really found the product market fit in their local market, because then it would have demonstrated the ability of a team to make these local iterations to adapt their product, and when they will just go into a different market, they will then be able to make new iterations to make sure that this market is now as well accepted in these new markets that they are going into. So yes, so this is my answer to your question. I hope I've answered it correctly. I don't want to be too long here.
I think it's a great answer, though, because I can even relate to it quite a lot, because when we evaluate startups, a lot of times we look at them very much in local context. And we try to then step back and really say, okay, now if this is working locally, how would that scale across the other countries? What difficulty would that startup face if they were to go from Kenya to Uganda to Rwanda and so on and so forth? So I think it's a great point. So thank you very much for that.
Yes.
We touched upon mistakes as well. And you said you made a few. And when you look at your mistakes, maybe looking at Coco, but you can also bring about another one. I don't want to rub it in your face too much, but
no.
Which mistakes
That's
have
okay.
you learned from, if you can just point one out? And what would you do differently today as compared to back then when you made that mistake?
Well, it also comes back to the intuition. So I'm not sure whether I would not make the same mistakes once again if I put myself back in my shoes a few years ago. Yes, I think that I would put more weight on the importance of the local context in the very early stages. Understanding the regulatory aspects as well. So, both the opportunity and both the challenges. I will also be very careful about, the type of informal informal competition and competitors that arise in the local market. There are so many ideas that I've looked at and I thought were very, very clear potential success. I was in Kenya looking at a project, and the founder was pitching to me a brilliant idea, and I was so excited about this idea. And when I came out of that meeting, and I won't mention the name, but when I came out of that meeting and I went for lunch with a local VC, and the local VC just told me, like, but this sector is just under the control of the mafia in a certain way. So that startup will never be able to penetrate that market. It's a very good idea. It would be great for that sector to get that sort of cashless transaction, but it's never going to work unless there is a political will, and more than that, more importantly, to clean the sector and to make it more transparent and all of that. So since then, I've been very worried about this local context and is it the informal knowledge, but the informal or hidden forces that are actually controlling some sectors. So that's for me a very important aspect, and I would probably dig further with the local investors about the SOM, the serviceable obtainable market, to really understand how are they making their assumptions that this could be a success in that country, how big the market is. I tend to sometimes I have benchmark solution in different countries, and when I arrive in a new country and I see a similar solution, I tend to think that this will follow the same path, and it will not be a success, or there's already too much of a competition there, and so I decided not to invest, and that has proven to be a wrong decision in the end. While on the contrary, what was very interesting is that we have invested into a payment infrastructure company called Up2, who is developing an interoperable solution in the West Francophone Africa, so Cameroon, Côte d'Ivoire, Senegal, and the other countries. And we had made the assumptions at the time that the Francophone Africa was a region that the global English Anglophone fintech would not penetrate in the next few years. So, and we actually we discussed a lot with the local operators, and we really understood that this was kind of a blue ocean. So the competition was fierce in the Anglophone Africa, while the competition and the competitors were not as strong, funded, or sophisticated than the solution that we wanted to build. So, the local people convinced me that even though I would see that as a very risky investment in the Anglophone Africa, in that market, it was a very interesting and tactical investment to be made. So at the moment, we're seeing a very good progress, and we hope that it will continue to grow as rapidly as it is right now.
I think that there were very many great points you just mentioned. And if I was a founder listening to this, I think I would just replay the last few minutes at least 2-3 times to make sure that they sink in, because it's very important. I can remember as well a time, I think we had like 2-3 of those companies as well, where we, in the end, even though we loved a lot about what this company was looking at doing and the market was big, we just said no, for example, because of we knowing how currently the state of the art kind of mafia operations behind there are. So we were just thinking, sure, it's great, it looks amazing, and it has a big market,
Deep.
but I think they might end up in a ditch before they succeed. So we said, like, we'd rather not. And I think
Yes,
that's a very,
indeed.
very good point that you mentioned from that perspective.
Mm.
Perhaps it's time to move on to the very last topic, and that is the effect that both of them have. And I'd like to ask you now a few questions at once because I feel they play into each other to some extent. The first is just in general, what effect do you perceive that foreign and local investors have on the ecosystem? And then the other two questions are basically centered around foreign funds and the past few years. Have you ever felt that foreign funds come in all at the same time and create a little bit of like a FOMO effect? Because if you're looking at the past few years in particular, I think the funding has gone what I refer to as like a roller coaster ride. One year there was too much money, the next year there was no money, then the year after again too much money, and now we find ourselves again in one of those down years.
Yes.
So I want to really hear your take on that.
Yes. No. Yes, indeed. And I must say, I only have 10 years of private equity experience. So I've started just after the great financial crisis, where it was very low and bearish market. So I tend to say that this is the first time that I'm really seeing that effect of a roller coaster on the funding. Yes. And I'll come back to that. But to answer to your first questions about the synergy and the effect on the ecosystem, I think that an ecosystem cannot work if, with several types of investors. So angel investors are key, and I would say are critical, because this is really where you can fund your idea. But it is as important to have, the local family offices, the local micro VCs, the corporate VCs as well, and definitely of the global VCs. Even to have like the pension funds and the sovereign local funds to invest into the local ecosystem, it would be even more important. And we can only impact the economy so importantly that everybody should be very worried about the fact that not everybody is playing its own role. But yes, so local guys invigorate the ecosystem. They provide a foundational support, and the foreign fund will drive that scalability and broader exposure. And what is interesting with that kind of snowball effect is that with success comes success and comes the followers. And we've seen that the ecosystem who have production, but who have made the most unicorns are actually the ones who are witnessing a local and global attraction of entrepreneurs in a certain way. So this synergy between local and global is key, and I can only vouch for it. Then when it comes to FOMO tendencies, yes, it is indeed. We've seen that Africa and the four leading ecosystems have really emerged as the next emerging markets and frontier market in venture capital. And obviously, we've seen the level and volumes of investment skyrocketing very rapidly over the last few years. And we've been, sometimes the startups have been flooded with money. And but when you compare that to the global volume of investments, that still represents just 1% to 2% of a global VCs. So while I think the money was probably have flooded too rapidly in the African ecosystems, and that some startups have raised I've raised too much. I've also witnessed that the best startups with the best teams, and I would say sometimes with the best CFOs in these teams, have used that money very efficiently. Have reached a good profitability levels, or EBITDA positive, and or at least of have a profitable margin on a unit economic level. So yes, I understand that at the moment, the funds who have funded those startups with just growth cash and not just how can I say that, efficient cash, are currently kind of monitoring very closely the performance of those startups, and are really making sure that they don't go bankrupt, and that they can keep their runway and their ability to not raise any bridge funding, or at least, and definitely not a down round before at least the end of 2024, and that they are rebalancing their portfolio, and that affects a lot the companies who are currently still witnessing good growth, and are profitable, and are ready to raise a Series A and a Series B, and can't really find those investors. And this has also affected the seed and pre-seed stages. And we've seen exceptional teams in the past few months raising, seed extension, in order just to be able to survive another 12 months, or at least to generate growth for another 12 months before the sorry, before the next before the market stabilize. Well, I won't continue, but just to make a note that we've reached almost 4 billion this year from the latest stats. So it's still a lot of money coming into the VC ecosystem. And for family offices, for example, it still represents a very liquid market, because there are still some very large B and B rounds and above, and where you can already get some liquidity and some of your early exit or partial exit, and that represents still a very interesting asset class.
Okay. Appreciate the answer. I agree with a lot of the points you made. And yes, 4 billion, we've reached the ecosystem. I think in general, like you're saying, we're still growing if you're looking at the overall trend lines, with the roller coasters in between, which we just have to ride out, correct?
Yes.
I mean,
just to give you some perspective probably on the portfolio, is that you have different type of investors, and they push for different type of strategy. But I think that in the companies I have invested into, a lot of them actually, obviously not all of them, but a lot of them are currently EBITDA positive. So, and I've been EBITDA positive for the last 6 to 12 months. So when we've seen that funding winter coming in, we were kind of ready to and confident that we could pass that situation, and ensure that we were ready when the sun comes back, to be able to show ourselves, and to showcase ourselves, and to be able to be in a very good position for the next series. So it's also what type of investor you are that define how do you navigate those roller coasters. And I think that from an entrepreneur perspective, that's also important, because that your investors are looking for growth, will push you to make that to take that risk, to make that move, and to enter into this market. But while on the contrary, will just make sure, or at least challenge you on how much cash you're burning, and that you're not, growing at all cost, because we see that now it's really kind of bouncing back, and there's very adverse conditions for those type of strategy. And I'm not sure, but about your type of investment strategy, or but given your background at Push, I would imagine that you are this very balanced type of investor, where given your corporate backgrounds, you ensure that the moves are bold, but not foolish.
I agree 100%. And thanks for actually throwing a nice question back at me. Yes, we look at it in, I would say, a very shrewd way, and we keep in mind the incredible opportunity that tech startups obviously have, when it comes to scalability. But with regards to the funding winter, for example, I spoke to every one of our portfolio companies middle of last year already, and told them just to be careful, to make sure that, they look at reaching EBITDA profitability, and in the end, that they're basically turning positive cash flow, so that when this funding winter hits, that you're not having to go out there and raise. And we told everyone, if you have to raise, do it now. Even when it comes to terms, if you have to go on the terms which are a bit less attractive, that's fine. But make sure you speak to your board, so you can have incentive plans, different structures created, in order to make sure that you just navigate and come out on the other side in a better shape. And we also hosted in the beginning of January, you can find that on YouTube as well, I don't know whether you actually watched it, Anand, who's the founder of Mensa Brands in India. So Mensa Brands became the fastest company to be valued at a unicorn within India, and I think the second or third fastest globally. And it's very interesting if you listen to that conversation as well, how he approaches call it business thinking as well, because one of the points that we also always made was unit economics and margins, because if you don't have margins, how can you support your growth, right? If your margin is tiny, then you have to capture the entirety of the continent and kind of transact 20% of the business on the entire continent, which is tough, right? So we are trying to be very shrewd and trying to be realistic, but at the same time also realistic about the growth opportunity that a lot of the startups have in tech, because it can scale just so much faster.
Yes. When you witness that growth, you kind of say, indeed, the digital solutions are something of their own. And I come from the private equity, where you would build factories and put that, you would turn on the factory for the first time, and every single, tube, or I don't know the English words actually, but would not eat appropriately, and the end result would not be perfect, and it would take 3 months to actually get the perfect extract, active extract, and all of that. So it's a different, it's definitely a different kind of business momentum. So when it takes off, it really takes off, and you have to be also ready to staff yourself to get that customer support team that can really ensure that both the client are satisfied, but also send the feedback loop to the engineering team and to the product team, so that they can improve rather quickly and ensure that you improve along the way and sustain the growth. So it's definitely very interesting to see that growth, to observe that growth.
Indeed, and those teething issues at times, in particular, as you mentioned, with the private equity background in factories, they do last longer. I always say, as being half German, I always say, when you drive your car, the first car you buy, if it's just a brand new car, don't drive fast the first 80 kilometers. Don't push down the pedal. Take it easy. The first 2,000 kilometers roughly is my guideline. And after that, I said, once the 2,000 is gone, hit it. Go for it.
Yes, great. I do that with my windsurf gear to come back. Not with a car. I go slow in the beginning, not just to be sure that I don't crash usually, if you just try to go very fast on the first mile, then you are up to for a crash, and you feel stupid after that. I don't know if that analogy can serve the entrepreneurs, but at least I would be happy to tell them to teach
maybe
them how to
they'll
windsurf
let
as
us know.
well. Yes, indeed.
Okay, maybe allow me to ask you one last question again, a little bit of two questions in one, and then I'll do the very difficult thing of attempting to summarize some of the talking points that we had.
Okay.
So, again, on the effect of both local and foreign investors on the ecosystem, how do you think investors deal with challenges in these markets that we operate in, such as talent sourcing, corruption, and exit paths? And can you assess, or can you think about ways that you maybe yourself have looked at currency risks? I remember we spoke about those before, and how we can mitigate some of those risks. What is your take on that?
Yes. Well, it is definitely how to say that, a very tangible risk, and it's quite difficult actually to hedge that very efficiently, and nobody actually does. So it's important to anticipate, to tackle, to put in place the right instrument or just the right strategy to do so. We looked at hedging instruments in the past, but they tend not to be always effective and definitely costly. And depending on how much you invest, obviously, it's not always relevant. So we usually ensure that the company is incorporated into a liquid jurisdiction, where I say that you don't have, any central bank restriction with regard to rapid repatriation of money. And then from that, I would say global jurisdiction, what we like to see is that startup will actually go international and penetrate different markets with different currencies. And in a certain way, we've kind of limit the fluctuation of FX, during its journey. So, and when we look at that on a 10-year horizon, we just hope that after that company would have grown significantly and reached different markets, that the discount on the country risk, on the FX risk, would not be as significant as as it might have been if a company have stayed into just one country. So that's how I see this. I know it's not optimal. I know it's not perfect. But what I've observed also, and based on multiple discussions with private equity funds, is that you have to be very thorough on your exit strategy and understand what is going on into the different countries that you've invested into and that your startups are operating into. And you might want to be able to exit before another roller coaster arrives, the another kind of winter arrives. And if not, you might have just to extend the life of your fund by 1 or 2 years to actually exit at the right valuation, which will return your investors a good IRR, a good DPI. So yes, it is. These are risks that you can't really avoid. Another strategy, or at least investment strategy, to try to avoid that for us is to invest into startups which are sometimes counter-cyclical, so which will resist some of these difficult economic downturns, because they are must-buy products or must-have services so that people will use no matter the economic conditions, and that might help just to demonstrate growth to your acquirer on exit. Yes. So, and I think you also shared with me the risk about the corruption. So this is definitely something which, as foreign investors, is a difficult yes or no answer. We tend to put in place very rigorous governance protocol because we'd rather just ensure that every risk is mitigated and we stay away from any of that corruption problem. But the local investors, they know their way into the regional intricacies, and they know their way how to speak to the right people and to get access to the regulator to ensure that the startups operate and within the legislation, but sometimes there's no legislation. But the startup can operate until the legislation comes up and is able as well to discuss in good intelligence with the regulators. So I think that that's another reason, actually, that we did not mention in the past, that the local investor can be immensely valuable in those situations where you need to discuss with the authorities, and foreign investors value that as well.
Okay, thanks for answering this and obviously also the other questions that I asked you. And now to my behemoth task of summarizing our talking points. Please keep an ear out and check whether I missed something important from your end. Summarizing our conversation, I would say first, you pointed out that local investors can really help foreign investors, particularly when it comes to validating the market and the timing of the idea. When it comes to the networks, you were saying that both have incredible networks, but different ones. So make sure you choose your investors well and that you also have, I would say, some diversity on your cap table.
Yes.
One point you mentioned on the local investors, though, is for you, it's a warning sign if there's no local investor, and you wouldn't invest without local investors being on the cap table.
Indeed.
The scalability is the one thing that is the key expertise from your perspective that foreign investors can add, and the pitfalls and best practices to look at when you're scaling across countries. And you would also advise your founders. Yeah, and you would advise your founders to make sure that they gather and measure data from day one so that they can essentially have data-driven decisions. And you mentioned a lot of foreign investors bring that to the table as well. But if they do it from day one, they'll be well prepared already.
Yes.
For the local investors, you mentioned the biggest selling point being their network and their ability to help you test your idea or your product, distribute it, and provide you with market access.
Indeed.
As well as
yes.
a big lesson that you learned is something that local investors bring, is the understanding of the local context and informal competition that at times exists. And you mentioned that's your biggest lesson that you learned, and
Definitely.
it will help you understand the serviceable, obtainable market better.
Yes.
Then we discussed the ecosystem, and you mentioned that both types of investors are needed, which is a great point because both have great importance and great things to add to the ecosystem. And last but not least, we discussed briefly the typical Africa question that a lot of people across the world would ask us when it comes to Africa, and that is risk management. And your take on that is you can't really avoid those risks, but you have to manage them properly. And one of the points you made was companies need to be incorporated in liquid jurisdictions, that they aim at going international, that we have a 10-year horizon, which is longer than some other countries, and ideally exit before the next winter starts, or diversify by also investing in some counter-cyclical startups. And the important aspect here, again, being have good governance in the company. And again, local investors can add, in case you do ever get in trouble, the ability to sort that out.
Yes, definitely. It's very important.
Fabrice, with all that being said, is there anything else you would like to add from your perspective?
No, nothing more. I think we discussed for quite a long time, and I don't want your auditors to feel that it's too long. But no, I love that conversation. I think that across the years we had a very interesting conversations around those topics, and it's a way here to sum this up and to share what we've learned and how we collaborated. So I thank you for your questions and for your time and for the ability to speak here on the Push Post podcast. And I'm really looking forward to co-invest with you in the next few months and few years.
From our perspective as well, thank you very much on behalf of the entire Push team, and also obviously from myself, for being here, Fabrice. And you're right, we did discuss a lot of these points already over the years. And I think for all those people listening, and on behalf of all the listeners out there as well, a big thank you. Yes, it was a long take, but at the same time, a very valuable one. And I believe a lot of people are going to enjoy listening to this episode. Now, to all the listeners out there, thank you very much for listening. You can find our podcasts on YouTube and Instagram and Facebook is where you can find us, together with Twitter, of course, which is now called X, for those of you who haven't heard yet. And you can find us there on Push Your Advantage hashtag. Next month, we'll be back with another installment on the African tech ecosystem, which is available on Spotify, Apple Music, AfriPods, and of course, YouTube as well. Thank you so much.